Welcome to today's Explainer. So glad you're here because we are looking at a company that is just literally tearing up the financial track right now. I'm talking about Sanmina, ticker symbol SANM. Now, if you've been keeping an eye on the market, you already know the stock has been moving insanely fast. But look, today, we're not just going to stand on the sidewalk and watch it blur past. We're going to treat this Explainer like a full-scale mechanical inspection. We're going to pop the hood, check the engine, read the dashboard gauges, and figure out exactly what is actually driving Sanmina's massive recent market performance.
So here's our inspection roadmap. We're going to start with the explosive stock run, take a look under the financial hood, run a valuation check to see if it's expensive or justified, dive into the health, debt, and margins, and finally calculate that final fair value.
All right, let's jump straight into Section 1, the explosive stock run.
Let's start by just walking around the vehicle and taking in the paint job. Because, wow, the recent market returns for Sanmina are absolutely eye-catching. Look at this number, 132.97%. That is Sanmina's total return over just the trailing 12 months alone. I mean, for a stock with a market cap over $10 billion, a run like that is just incredibly impressive. It shows you exactly how fast this company has been accelerating in the short term. It's easily outpacing the broader market averages and, frankly, turning heads across the whole financial landscape. But let's zoom out for a second. You know, any stock can have a lucky year, right? Well, a staggering 682.36% return over the last 10 years, that proves this performance isn't just some sudden flash in the pan. Actually, if we look at the compound annual growth rate over that entire decade, it comes out to nearly 24% per year. Think about that. This is a machine specifically built for sustained speed, year after year after year. So the really crucial question we got to figure out today is this. Is this momentum actually sustainable? It's the implicit question every focused investor has to ask when they're looking at a skyrocketing stock. Is this blistering speed justified by the underlying fundamentals of the business? Or are we just looking at overpriced market hype inflating a bubble? Well, to answer that, we've got to get our hands dirty.
Which brings us to Section 2, under the financial hood.
Okay, we're moving past the stock price now and opening up the engine block itself to analyze Sanmina's core fundamentals and their trailing 12-month growth rates. And right away, opening things up, we see this really dramatic contrast in the metrics. Top-line revenue, up a very solid 21%, sitting at over $9.3 billion. But look right below that. Net income is actually down slightly. It's sitting relatively flat at negative 0.13%. Now, normally, a flat net income like that would be a glaring red flag. But then your eyes hit the bottom row. Free cash flow has absolutely exploded by over 182% in that exact same time frame.
Let's pause for a second just to make sure we're totally clear on why this matters so much. Free cash flow is the cash a company actually generates after accounting for the money it needs to spend to maintain its operations and capital assets. Think of it as the true, pure fuel of the company's engine. While net income can get, skewed a bit by non-cash accounting expenses, free cash flow is cold, hard cash. So seeing a 182% surge in FCF, that is a massive, incredibly bullish signal. It tells us the engine is highly efficient at converting revenue into actual usable cash, completely independent of whatever that flat net income might suggest.
Moving right along to Section 3, valuation, expensive or justified.
Now that we know the engine is generating massive fuel, let's go ahead and check the dashboard gauges. We need to see the premium the market is currently charging us for the keys to this vehicle. Sanmina's current price to earnings, or PE ratio, is sitting at 44.89. That means right now, today, investors are paying nearly $45 for every single dollar of earnings. Compare that to the 3-year historical average of 22.86. The market is charging a massive 96% premium compared to what it usually prices the stock at.
Let's check another critical dashboard gauge here, the enterprise value to EBITDA ratio. By taking debt into account, this acts a lot like evaluating the true total cost of ownership rather than just looking at the sticker price. And well, the story here is exactly the same. The current EV/EBITDA is 19.76. That totally confirms the overall trend, showing the stock is trading at roughly a 71% premium to its own 3-year average of 11.51.
So, to summarize our valuation check, by almost every single relative valuation metric out there, Sanmina has become objectively expensive relative to its own history. Even if we look at the price-to-book ratio, which currently sits at 4.13, we're seeing a 60% jump over its 3-year average. Look, the market fully knows this car is fast, and they are absolutely 100% charging a luxury price tag for it.
Let's head into Section 4, health, debt, and margins. High valuations are really only justified if the underlying structure is rock solid. So let's transition over to checking the overall structural health of the company to see if the mechanics can actually support this heavy valuation weight. Let's balance the scales here. On the excellent side, we've got a highly favorable debt-to-equity ratio of 0.88. As you probably know, anything under 1.0 generally means the company relies way more on shareholder equity than debt to finance its assets. That is great structural integrity. But on the concerning side, we have a return on invested capital, or ROIC, of 6.39%. This is down over 50% from its 3-year average of roughly 13%. Basically, this means the company is currently less efficient at generating returns from the capital it's deploying than it was just a few short years ago.
Looking briefly at the margins, it's honestly a bit of a mixed bag. The net profit margin is a bit thin at 2.96%, which is slightly down from its historical averages. However, the gross profit margin is 8.58%, and that's actually up compared to its 3-year average. And really importantly, the current ratio sits at 1.70. This measures short-term liquidity, and a 1.70 means Sanmina has more than enough short-term assets to easily, comfortably cover its short-term liabilities. So while capital efficiency has dipped slightly, the overall financial chassis remains highly liquid and really well managed.
And that brings us to our final stop, Section 5, the final fair value. We've admired the speed, we've inspected the engine, we've checked those very expensive price gauges, and we've evaluated the structural chassis. Now, it's time for the crescendo. We're going to find Sanmina's true Blue Book price using a discounted cash flow appraisal. Let me just quickly walk you through exactly how this verdict is reached. Step 1. We note the current trading price, which currently sits at $188.08. Step 2, we calculate the intrinsic fair value of the business based strictly on that massive free cash flow engine we talked about earlier. And finally, step 3, we compare those two numbers to determine our overall margin of safety. And here is the result. The discounted cash flow fair value price is a massive $235.92. Now I know what you're thinking. Despite all those dashboard gauges flashing earlier that the stock is historically expensive on earnings and book value, this intrinsic appraisal tells a wildly different story. And the reason for this incredibly high appraisal, it's driven entirely by that explosive 182% free cash flow generation. The math simply says that a company pumping out this much actual cash is incredibly valuable.
Which leads us straight to this absolutely vital conclusion. The margin of safety is 20.28%. Because the calculated fair value of $235.92 is significantly higher than the current price of $188.08, investors theoretically still have a 20% cushion. This means even after a crazy 132% run over the last year, the cash-generating power of this business is so exceptionally strong that the stock is technically still undervalued, based purely on its future cash flow potential.
So we end our inspection right here. You've seen the eye-watering historical returns. You've seen the historical premiums the market is currently charging. But you have also seen the undeniable underlying cash flow engine that is powering this whole operation. The numbers present a truly fascinating dynamic between historical pricing and future cash flow valuation. So I'm going to leave you with this. With a 20% margin of safety based on its free cash flow, is Sanmina's powerful engine worth the premium price tag? And is it the next addition to your portfolio? Thank you so much for joining me for this explainer. Keep asking the right questions and happy analyzing.